see we're at 99 people, so I am going to get us started and we will wait for the rest to join us. So welcome everyone, and thank you for joining us this afternoon. I am Farah Kimji, the founder of Futura Funds and the president of Toronto Crew. We are so happy to have all of you join us online for today's signature event. For all of those joining, both members and non-members, the mission of Crew Network is to transform the commercial real estate industry by advancing women globally. With over 75 chapters and 12,000 members, Crew Network has provided the platform and support necessary to deliver on that mission for over 30 years. And we are committed to this now more than ever before. 2020 was a challenging year for all of us on so many fronts, and we at Toronto Crew were not immune to those challenges. We chose to face those challenges head on by being creative, agile, adaptive, and innovative. In 2020, we produced over 40 events, and we found creative ways to deliver our programs in a new format, including all of our signature events, Real Jobs Day, professional development offerings, community outreach, our mentorship program, and we even formed 2 new committees, our Past Presidents Committee to act as advisors and provide support to our other committees, and our IDEA Committee to promote and foster inclusion, diversity, equity, and allyship within our membership and the industry at large. And we have started 2021 in a strong position, exceeding our sponsorship targets with over 70 new members joining as well, joining so many of our long-standing and renewed members. This year also marks the 25th anniversary of Toronto Crew, and we are very excited to take a look back and celebrate the milestones throughout those years while looking forward to the next 25 with a renewed sense of excitement as our industry continues to transform and innovate. We have a committee that is hard at work planning an exciting celebration that will take place in the last quarter of the year, so stay tuned for more on that. For today's event, we are joined by our fellow Canadian chapters, including Vancouver, Calgary, Edmonton, Saskatoon, Montreal, and Nova Scotia. Our 7 chapters really came together during the pandemic, recognizing that we could lean on each other as we navigate challenges, that we could use the opportunity to share our virtual programs to offer more value to our members and sponsors, and that we can collaborate in new ways to create Canadian content for our industry to partake in, including this afternoon's event. It has been so great to collaborate with my fellow chapter presidents, and we look forward to continuing and building on the strong foundation we have built for years to come. We would not be able to deliver on all of these fronts without the support of our sponsors. I would now like to take a moment to thank our 2021 sponsors for our respective chapters. So we have Vancouver, Edmonton, Calgary, Saskatoon, Toronto, and Montreal. Your sponsorship allows us to deliver relevant, educational, and engaging programming for our members, and we are very appreciative of your support. So thank you. Now, let's move on to our main event, our annual Economic Outlook. This event has been organized by our Programs Committee and is brought to us by our presenting signature sponsor, Oxford Properties. And joining us today to share some opening remarks is Alicia Valenti, Executive Vice President and Chief Legal Officer at Oxford Properties and former Director on the board for Toronto Crew. Over to you, Alicia.
Hi, everyone. Thanks so much for your introduction, Farah. I'd say good morning, good afternoon, and good evening from wherever you're watching from in the world. I'm so pleased to be here. And we are very proud at Oxford to be the signature sponsor of today's Economic Outlook with Dr. Shenfeld. As most of you know, Oxford is a leading global real estate investor, asset manager, and business builder with over $60 billion of assets under management, with investments in 9 countries and 4 continents. We're also proud supporters of Crew and our many amazing Oxford employees who are not only members of Crew, but who are leaders within Crew, actively volunteering their time on projects, committees, and boards in support of Crew's mission of transforming the commercial industry, real estate industry by advancing women globally. We also couldn't be happier that our very own Kim Train is the current president-elect for Toronto Crew. So thank you, Toronto Crew, and all of the Crew chapters for allowing us to sponsor this event. And I'm happy to hand it back over to Farah to introduce Dr. Shenfeld, who never disappoints. And in following his recent media commentary, I'm sure he'll be sharing some views on the great inflation debate. So back to you, Farah.
Thank you, Alicia, and thank you to Oxford for your continued support of Toronto Crew. I would now like to introduce our guest speaker for this event, Dr. Avery Shenfeld, the Managing Director and Chief Economist of CIBC Capital Markets. Dr. Shenfeld has been with CIBC since 1993 and is widely recognized as one of Canada's leading economists for his perceptive analysis and insight on economic developments and their implications for financial markets. He is a repeat winner of the Dow Jones Market Watch Forecasting Award, and he has received awards for forecast accuracy on the US and Canadian economies by Bloomberg Markets. He has also been consistently ranked as one of the top Canadian economists by institutional investors. We feel honored to have Dr. Shenfeld join us today and his continued support of Toronto Crew and this specific event for the past several years. I can't count, but maybe Dr. Shenfeld, you'll remember. So Dr. Shenfeld will speak for about 35 minutes, and we will open up the floor after that for questions, where we will be joined by Christy Thompson, Senior Design Market Manager with Hayworth, and also a board director with Crew Calgary to moderate our Q&A. We encourage the audience members to submit questions throughout using the Q&A feature. And yeah, all right, without further ado, let's kick off the event. Over to you, Dr. Shenfeld. Thank you.
Thanks very much, Farah, and it's indeed my pleasure. I don't know how many times I've done this in the past, but it's my pleasure once again to be in front of now, this time, not just the Toronto chapter, but the national chapter of an organization that I think is very important in a sector that's actually very important to my own bank, CIBC. We work very closely with a lot of commercial real estate participants across the country. And my own bank is a strong believer in the value of diversity in terms of our own leadership team. And we're very encouraged to see that diversity, I think, beginning to grow across the country in many sectors, including commercial real estate. If I think about the economic outlook today, it's really almost like a forecast of a disease rather than the economy. And I've called my presentation the arms race, because really what we're in right now is a race to get our arms out, to get vaccinated, and use that as a way of getting the economy back to something closer to normal. So that's not a missile in this title slide. That's actually a picture of a syringe. That's really the weapon that we're going to use to get the economy back in gear, back the way we would like it to be, particularly for elements of the commercial real estate sector that have been, I think, to some extent, partly front and center in some of the disruptions that we've seen in the past year. And the good news is that we do seem to be making progress in vaccination, not just in Canada, but around the world. And so if we look at growth rates, and I'm going to use this little hand signal, by the way, to indicate, just change slides. If we look at growth rates around the world, the global economy was hammered last year. Let's not make any bones about it. It was a terrible year for world economic activity. You rarely see so many countries in such a deep contraction as we saw in 2020. But the rising tide of vaccinations and hopefully getting then COVID under control in the latter half of this year should allow for significant economic growth around the world in 2021 and 2022. And here's a little bit of quick breaking news. We actually just upgraded some of the forecasts presented here. We now have the US growing at 6% this year, Canada at 5.6%. Now, but what is worth noting here is the gap between those numbers on the US and the numbers on Canada. If you go back to last year, Canada's economy contracted by almost 5.5%. the US down around 3.5%. So we dug ourselves a deeper hole, in part because we took tougher measures to get COVID under control a little better and to keep our death rates running below those that we saw stateside. But we also have the US economy then growing faster in 2021. That's a combination of more fiscal stimulus, more aggressive fiscal stimulus, that is for 2021. The fact that the US economy is ahead of Canada in vaccinations is going to make, I think, a big difference in second quarter economic growth in particular, where we're sort of shutting things down again. They may not have to, at least not at the national level, the way we are here. And as a result, the US economy is going to get back to something closer to normal a bit earlier than Canada. And that's going to be important because it may have some impact on both the interest rate outlook in the two countries, as well as the exchange rate outlook in Canada and the US. And then in the rest of the world, you can see, again, some differences. UK hit very hard last year, along with Europe, beginning to recover again, but Europe a little bit behind even Canada in vaccinations, so maybe not as much growth until we get to 2022. But overall, things are getting better, even though in the near term, they're not going to feel that way, particularly here in Canada. And in terms of what's driving that expansion, it really all comes down to the consumer, and in particular, unleashing the spending power that already exists in the household sector, and in the US, spending power that's now being amplified by checks going from Washington to the vast majority of American households. The story of 2020 was really a story of Americans and Canadians not being able to spend the way they normally would. So this isn't about the 1%ers, the top 1% of income earners. This is really a story of the 90% or so of us who didn't lose our jobs, but had to rein in spending because we didn't go to the movies, we didn't go to restaurants, we didn't travel. And as a result, huge amounts of excess savings piled up in the hands of Americans and Canadians. In the US, that's worth at this point almost 8% of a typical year's income sitting in extra savings. And there's still some further checks associated with the second stimulus package, or really the third stimulus package that was passed in the last month or so. And this is more than enough spending power to drive the economy for the next 2-3 years. I like to say that Americans and Canadians are just dying to go to restaurants, dying to travel. They just haven't been willing to risk dying to do those things. And as COVID fades away, and we think it will in the latter half of this year, we're going to start to get more and more of that pent up spending power show up in the economy in terms of actual spending. In addition, of course, in the US, we've also had a changing of the political guard, new resident at the White House. There's Donald Trump waving goodbye. Maybe he's waving to his supporters to launch another attack on the Capitol, I'm not sure. And there's a smiling Joe Biden looking like the winner he actually was in that election. And that has some implications, that change in administration, some of which we've already seen. So we've gone from a president who at one time gave a speech complaining that COVID was all anyone wanted to talk about, to a president that is putting COVID and getting it under control front and center. And although Trump gets some credit for financing the new vaccines we now have, or at least some of them, I think Biden gets some points for, I believe, managing that process and also encouraging Americans to do things like wear a mask while the virus is still out there. The second big difference is, of course, this massive additional stimulus bill, $2 trillion on top of the nearly $1 trillion that was passed in December. That's way off the charts in terms of economic stimulus, well beyond what Canada is going to be doing in 2021, or really well beyond anything we've seen in the US economy. And that's going to amplify growth in the next couple of years. But I do caution that it's also going to bring forward interest rate hikes that will be slowing economic growth when we look into, say, 2023, 2024. So if anything, maybe the stimulus package was a little too big for the need in the economy over the next couple of years, with so much consumer spending power already there. Tax hikes is another item on the Biden agenda. We'll see whether or not Congress can push those through. Higher corporate taxes, higher taxes perhaps on upper income Americans are coming. So that's maybe a bit of a drag on growth further out. Climate change, a much bigger initiative there that had some crimp on Canada's pipeline hopes and dreams. A new negotiating round with China, again, see where that goes. But one of the concerns we do have about Biden on the Canadian side is, although they are planning to try to ramp up infrastructure spending, at the same time, Biden is a big believer that infrastructure dollars should be subject to a tough Buy America test. That's going to make it difficult for Canadian companies, not only ones that want to bid directly on these projects, but even potentially as the suppliers of steel, aluminum, or lumber to a US bidder on those projects. And we'll be at pains to try to negotiate some sort of Buy North America deal where we get around that, perhaps in exchange for giving better access to the Americans when, particularly at the provincial level, we do infrastructure spending. So some wins and some losses for Canada in this change of administration. But overall, a strong US economy is, of course, a very good friend of getting a stronger Canadian economy as we look ahead. Here in Canada, the biggest motivation for the turn that we see coming is still, though, on our home front. It's on the fact that Canadians, like Americans, have been sitting at home, haven't been traveling, haven't been going to restaurants, haven't been going to live sports events or concerts. And in exchange, what they've done is really left money unspent. So if you look at personal bank deposits, for example, and we hope a lot of these deposits are at CIBC because that's the bank I worked for, but you can see that if you aggregate them up, they're up more than 20% from a year ago. That's unheard of. And that really represents the money that Canadians would have spent in normal economic times. Now, they're not going to rush just because they've got a vaccine and go to restaurants 5 times a week or book 4 vacations in a single month. But having this backdrop of money on deposit should mean that, first of all, they feel less eager to continue to save as they get employed, but maybe even dip into some of this money for one-off type spending. Much of this is going to show up in services. If anything, in the latter half of the year, we may actually see a cooling in goods spending. You don't need another office chair or a third computer because your kids are studying at home. And you won't be going to the grocery store as often. You'll be going out to restaurants as part of your shopping behavior. So again, switching from goods consumption to a service. And some of the things we don't even think of as consumer spending count in the way we measure GDP. So if you, like I have been a little bit wary about going to the dentist, for example, while COVID is raging, and we book our appointments after we have our vaccines, that's going to lead to an increase in what we call deferred essential services, things like dental visits, office visits at the doctor's office, and so on. So a lot of spending power. Just don't expect to see this in the current quarter, because if anything, we're going the other way. We're clamping down in an effort to get COVID under control. And we did a survey of Canadians asking, well, where do you think you're going to spend all this savings that you have? A lot of people mentioned travel. That's not such great news for Canada because some of that means travel abroad, but it's certainly a plus for Canada's hotel sector, at least the hotels aimed at leisure travel. Elsewhere, these don't add up to 100, by the way, because you could check more than one box in terms of what you're going to do with the money. A lot of people gave answers that they probably think sound prudent. Oh, I'm going to invest that money. I'm going to build up my savings. I'm going to pay down my debt. Truth be told, these kind of surveys always exaggerate those sorts of answers. They're the answers that people think they should give the pollster, rather than maybe the truth is a little more of the category on the right there. I'm going to spoil myself and go to a nicer vacation or have a dinner at a restaurant and so on. I think it'll be a mix of both, but certainly lots of reason to expect much better consumer activity late this year and into 2022. That's going to be a rising tide that pretty much lifts all boats. They always say in real estate that it's all about location, location, location. Well, in this case, virtually every location is going to look better in the latter half of this year in 2022 as COVID fades away, some a bit more than others. Alberta's growth rate looks pretty good, but you can see in the column for 2020, it had the biggest decline along with another province, Newfoundland. Those two provinces, of course, not just suffering from COVID, but also they were effectively leaking oil. The weak oil price environment was hurting. And Alberta's had a number of soft years. So this isn't necessarily, even though it looks like a good 2 years ahead, that's not going to completely restore the kind of vigor that we saw in the oil producing provinces back in 2014 when oil prices were substantially higher. But generally speaking, pretty reasonable improvements in economic activity when we look across the country. Some provinces have a little bit more vigor coming from capital spending. It actually looks at this year, at least, business investment spending, and this chart includes government investment intentions as well, look pretty weak still for 2021. So having seen declines in just about every province in capital spending in 2020, very few provinces are reporting much of in any way of growth. A little bit of a positive for Quebec and BC built into our forecast based on these responses, which come from a Statistics Canada survey of business and government organizations. So we probably don't get a lot of capital spending, new capital equipment construction until we get to 2022, by business, that is. Now, for the real estate sector, overall, a better economy is, of course, welcome news. But for real estate asset prices, a stronger economy always brings a little bit of an asterisk, because usually that also means rising interest rates. And so the question is, when are we going to see interest rates move up as the economy improves? And between Canada and the US, who's going to do that first? So if you actually look at what financial markets are pricing in right now, if you look at the futures markets or the forward curves, essentially the market expects the Bank of Canada to hike rates around the middle of 2022, which is actually a little earlier than what we expect. We think fourth quarter of 2022, and I'll explain why. But oddly, the market thinks that the Federal Reserve will go well after the Bank of Canada. And that's largely not because of the economic data, but because of the messaging that these two banks central banks have provided. So there's our governor at the Bank of Canada on the left, and of course, being fluently bilingual, he's saying, après vous, Mr. Fed chairman. And there is the chairman of the Fed on the right, Jay Powell, and he's saying, no, after you. Because the Federal Reserve has been, at least to this point, saying, we're not going to raise interest rates until 2024. The Bank of Canada, its last messaging was we could hike rates in 2023. And since they said that, which was in January, they've actually been raising their economic growth forecast, hinting that maybe they could even start raising rates in late 2022. To me, if I had to look at what these two central bankers are saying, I put a lot more confidence in what Tiff Macklem at the Bank of Canada is saying, and have serious doubts that the Federal Reserve will actually hold off on interest rate hikes nearly as long as they are saying. Because in our view, if they were to do that, we would have a serious inflation problem by 2023 and 2024. And let's look at the logic of why we see the US moving first. Well, most of that is based on things we already know, nothing to do with the forecast. We know that the US had a smaller economic downturn last year and is closer to being back at a full employment economy already. What this chart measures is it puts them both on a common scale called the output gap. And really that measures where is GDP relative to where it would be if the economy were at full employment. And I was just at the point where the economy was used up a lot of slack, but not yet in an environment where it's overheating and causing inflation to seriously escalate. Well, we think the US will have eliminated its output gap before the end of this year, given its head start, given its lead in vaccinations, and given the fact that it has a lot more new fiscal stimulus coming in Canada. In contrast, Canada will not close its output gap until late in 2022. And so there's every reason to believe that the central bank in Canada has to keep low interest rates around longer than the US does, given that economic gap. The Bank of Canada also has another reason for trying to let the Federal Reserve move first on interest rates. And it's because of a lesson that we learned a decade ago. So back in 2010, we were coming out of a recession that had taken place in 2008. And that was the opposite story. That was a recession linked to the collapse of the US subprime market and the implications of that for Wall Street. It was a much tougher recession in the US than in Canada. So the Bank of Canada thought that by 2010, even though the Federal Reserve was sticking with near zero interest rates, that it was reasonable for the Bank of Canada to start hiking. And they hiked 75 basis points. So they widened the gap between Canadian and US interest rates by that 75 basis points. That didn't seem like a lot, but it caused the Canadian dollar to go from sort of 79 cents all the way up to parity against the US dollar. And in the end, although the interest rate move wasn't big, that huge climb in the exchange rate did a lot of damage to Canada's export sector. Damage that really we didn't then reverse over the subsequent years. We permanently lost a lot of manufacturing facilities as a result of that overvalued exchange rate. The Bank of Canada seems to now understand that when dollar Canada is 125 or 120, in other words, we're more like an 80 or 85 cent exchange rate, we don't do particularly well on exports. It's only when dollar Canada is above 130, in other words, we're more like a 75 cent exchange rate or weaker, that we tend to get a solid contribution to growth from exports, which is another reason why then the Bank of Canada doesn't want to experiment with raising rates first. It's already a little concerned about the strength we've had in the Canadian dollar and doesn't want to push that any further. In fact, the strength of the Canadian dollar is also a little bit exaggerated by another factor, one that will disappear, and it relates to the balance of trade in goods and services. So right now, in the most recent quarter, we were running a pretty big deficit on goods trade. You can see that in the middle bars there. Our goods trade deficit was actually wider than it had been in 2019 on average. But where we've won is that we've eliminated the typical deficit that we have in services trade. So what's going on there? Simply put, it's the lack of travel. Typically, in a given quarter, many more Canadians go outside the country than foreigners visit Canada. And that creates actually a demand for US dollars as we travel that exceeds the demand for Canadian dollars from visitors here. So we've lost that temporarily. That's helping keep our currency on the strong side. But we do know that when COVID disappears, we're going to go back to traveling again. That deficit will reemerge. And that's another reason, along with a later rate hike from Canada as opposed to the US, that we believe the Canadian dollar will be a bit weaker next year rather than stronger. There are other things. So in terms of the timing of the first rate hike by the Bank of Canada, I always tell people, don't watch the inflation rate. It can bounce around for all sorts of reasons. And in fact, in the next few months, it's going to look quite elevated because we're going to be comparing prices this year to extremely low prices, particularly for gasoline, in the period where COVID first hit in 2020. So we're going to see some elevated inflation numbers. The Bank of Canada will know that those are temporary. What it really tracks is that output gap measure. As long as it's negative, the Bank of Canada keeps interest rates low. It's only when that output gap goes positive, in other words, there's no slack left and they start to think inflation's going to emerge, that they tend to raise interest rates. So put your pin right now on the calendar for the fourth quarter of 2022. That's as good a bet as any, is when we start to see interest rates creeping higher in terms of floating rates. So that still gives us a period of very low rates. And for the real estate sector, one positive here is that interest rates, even in good times, don't go where they used to go in good times. So if you look back at the last cycle, for example, and this wasn't just true for Canada, it was true for the Federal Reserve, the Bank of England, the Reserve Bank of Australia, and the Bank of Canada. If you look at how high did interest rates get in the last cycle, before the economy started to cool a bit and tell the central bank that they'd done enough, the answer typically was not much higher than 2.5%. In fact, in the Bank of Canada's case, we never got short-term overnight rates higher than 1.75. And you could see how different that was than the business cycle that started after 1990, where short-term interest rates got to the 8-10% range or even higher in the UK and Australia. Simply put, the structure of the economy these days, it doesn't take as high an interest rate to cool growth and keep inflation under wraps. So we think the Federal Reserve is misguided in thinking it can hold off on any rate hikes until 2024. But ultimately, we do believe that when rate hikes come, it's going to take a few years to get short-term interest rates up into the 2% range, which is still, by the standards of more distant history, still a fairly low rate environment in terms of what it means for the real estate sector overall. If we think about longer term rates, they actually have a relationship to those peak or normal short-term rates. So what this chart looks at is we have a longer history of this data for the US. It looks at that short-term rate that just balances the economy out when you're at full employment, just the rate you need to keep inflation at bay. We call that the neutral rate of interest. And the neutral rate of interest has been falling over the decades. It now sits around 2.5%. And as you can see by this chart, typically 10-year government yields fluctuate above and below that neutral rate. So we will at some point have 10-year government yields in the mid 2% range in the US, probably something reasonably similar in Canada. We're sitting right now with 10-year rates in Canada more like 1.5%. So they will end up, long-term rates will end up about 100 basis points higher than they are now. But it could take several years to get there. And even that rate is not a particularly challenging one for the real estate sector. Now, some people are worried that, in fact, we're going to see something worse than that because they're worried that inflation is going to really take off, that the central banks will not fight it the way they normally did, and we'll end up with a big inflation overshoot that causes much higher nominal interest rates. And certainly one chart that we used to follow, if you were an old school economist, you listened to some old school rock and roll, and you also followed some old school economic charts, you'd be looking at a chart like these two here. And what this measures is the growth in the money supply in the US and Canada on a year-over-year basis. And in both cases, if I hadn't lifted the scale above where I needed to chart it in the last decade or so, we'd be off the chart. In fact, the US money supply growth rate over the past year, you have to go all the way back to the Roosevelt administration to see something like that. And for history buffs, I'm not speaking about FDR, Franklin Delano Roosevelt. I'm actually speaking about Teddy Roosevelt. In other words, early in the 20th century. In Canada's case, the only times we've had something close to this money supply growth, we did have it, but in the very high inflation era of the 1970s. So is this all this money printing by central banks that you hear about? Does this mean that we're going to face a huge inflation down the road? Well, one question you might ask is, if money supply growth causes inflation, why aren't we seeing it now? And the answer is, you just have to understand what this actually measures. The money supply is really the sum of all the deposits that are out there. And as I showed you in that chart for Canada, those deposits are mostly in the hands of households. Business deposits are also a bit elevated, but the money is just sitting there. It's not being spent. So if you look at this next chart, and the chart at left, M2 shows the really above trend growth in the money supply. And it's almost the same number as the above trend growth in household savings. So if money is just sitting there and not being spent, it can't really drive inflation. And similarly, the other thing that sometimes happens when banks have a lot of deposits is they start aggressively making a lot of loans. And overall, if you look at the ratio of loans to deposits, and here I showed a US chart, it's actually down substantially. So we're not getting this money circulating in the economy in a way that could drive inflation. Now, when COVID is over, that's exactly what could happen. So that's why, in fact, the central banks will have to raise interest rates. If left unchecked, all this spending power in these deposits would cause an elevated inflation. We're just trusting the central banks to do the right thing, contain inflation into the 2% range over the medium term by slowing the economy down enough when we get to 23 and 24. And so that does suggest that bond yields today don't really have a lot of reason to continue to climb the way they did in the first part of the year, until we're further along in this economic recovery and closer to those short-term interest rate hikes. We can actually measure what inflation assumption the bond market is already building in. And it's easier to do this for the US, where they have a product called inflation swaps. They work a little bit better than what we call real return bonds in Canada or TIPS in the US as a way of figuring out what inflation expectations are built into the market. Those inflation swaps right now are trading as if CPI in the US will average about 2.5% over the next decade. And we have actually adjusted that to match the Fed's preferred target for inflation, which tends to run a little lower. It's the core PCE price index. So right now, the market is assuming that inflation the next decade will be around 2%, and that's the Fed's target. And that contrasts to where we were at the beginning of the year before we've had this bond market sell-off, where for whatever reason, the market was skeptical that we would ever get back to 2% inflation. So some of the climb we've seen in bond yields this year is, simply put, the market pricing in a reasonable expectation for inflation to make a comeback. I don't think there's much more pressure on rates from that. So we may get 10-year rates another 10 or 15 basis points higher this year. But I think in terms of going further than that and eventually getting to, another 100 basis points above where we are now, that's going to be a multi-year story as central banks raise rates. So this chart, in fact, shows what our interest rate and exchange rate forecast is. Apologies for those who need reading glasses when this chart comes up on their screen. But what it tells you is that floating rates, which are tied to the Bank of Canada's overnight rate, will not move until late next year. 10-year rates pretty much in a range for the rest of this year, and then starting to move higher in 2022. And you can see, because our view is that the Federal Reserve will raise rates ahead of the Bank of Canada, we have the Canadian dollar actually depreciating a little bit towards 75 cents US next year as the Fed hikes and the Bank of Canada holds off a bit. What about the other thing that people sometimes think about in terms of interest rates, though, is what about all the government deficits? And it's not only the fear of interest rates sort of compounding because of all that government borrowing. Of course, these days we're a couple of weeks ahead of a federal budget. A lot of questions I get from clients saying, are taxes going up on my corporation, on my personal taxes to pay for all these budget deficits? And my view is they don't have to. If you look at what we've done, we've run a massive budget deficit in the past year. 15% of GDP, pretty much unheard of unless you go all the way back to World War II. But there's a big difference between these deficits, which are very temporary and will melt away quite quickly when COVID disappears and all that COVID-related spending goes and government revenues come back with the economy, and the kind of chronic deficits that we had in the 80s and 90s, where really spending and revenues, even in good times, were very mismatched. And so if we haven't borrowed for a long period of time, and we've also borrowed at extremely low interest rates, we're not building up the same sort of debt service burden that we did in the 80s and 90s that then required either big tax hikes or massive permanent spending cuts. And in fact, the right way to measure the burden on the government is not the debt, because unlike your company, the government lives forever. They never have to pay down the debt. They roll it forever. What they have to pay is the interest on the debt. And going into this downturn, Canada actually had one of the best performances in terms of what proportion of GDP was going to pay interest on our federal debt. And even looking ahead to 2025 and allowing for a higher interest rate environment, and maybe another year or so or two of elevated deficits, we're still going to be in pretty good shape. So if tax hikes do come, and I'm not saying that that's unthinkable in the years ahead, they're going to come because the government opts to spend more money on something, introduce new programs, or shift the burden of who pays for things, rather than because of the deficits we've run in the past year or two. One of the other factors that has been holding down bond yields as the government has done all this borrowing is the fact that the Bank of Canada has been ramping up its holdings of Government of Canada bonds under what's called quantitative easing, or QE. And this is not something that you can continue to do in good times. Otherwise, you would have a big inflation problem. And in fact, the Bank of Canada is facing a more immediate constraint, which is what the chart at left shows, that if it kept buying what it has been buying, it would end up owning half of the Government of Canada bonds outstanding. So it is going to start to slow its purchases after April, gradually wind down this program. But we don't think that causes a major spike in bond yields, because as we look ahead, although the Bank of Canada won't be doing all this bond buying, we also think that federal government spending will drop post-COVID and they won't have as much financing requirement to do. So those two things will help offset each other to some extent. So let's think about what the world then looks like post-COVID, particularly for the real estate sector. And the real question is life as we knew it going to return? Or is this, as the song in Aladdin went, and I'll spare you my singing, is this a whole new world, not only for the economy, but for the commercial real estate sector? What is the future for our stores, offices, hotels, and so on? Well, I like to use a concept called revealed preference rather than a crystal ball, which says when households and businesses had choices, what choices did they make? So let's talk about, for example, I already mentioned leisure travel rebounding sharply in the years ahead. We know that because before COVID, actually around the world, people were choosing to spend a higher portion of their income on leisure travel. Business travel, though, maybe held back for a while, and some business travel maybe ended up replaced by technology like the one we're using today, but not all of it, but there may be a slower recovery there. I think shopping, again, online sales have picked up a massive market share, and there was a trend. So there was a revealed preference towards increasing use of online venues before COVID hit. So that suggests that online might retain some, but not all of the share it picked up. You're going to go back to the grocery store. You're going to go back to trying on a sweater in a mall rather than have it show up at your door and it's the wrong size or the wrong color. So shopping will return, but I suspect that some of the market share gained by online approaches will be retained. Same thing for online banking. We've taught even the 80-year-olds how to bank online. And that's going to mean, I think, a permanent reduction in at least some of the retail space use. And this was a trend we were already seeing. You know, services were gradually filling up some of the retail space on main streets. We were starting to think about, do we need to repurpose some older strip malls and so on? And then the good news is there is a repurposing that is, I think, very much needed in Canadian cities, which is residential. So we may end up shifting some of our retail space to residential over time. In terms of offices, I haven't enjoyed working from home. I'll be honest, I've hated it. I think that most people will go back to working in offices other than in the tech sector. And therefore we'll need most of our office space as opposed to working from home. And that's what this survey suggested. It suggested that while people surveyed were, huge numbers were working entirely from home, the number of people who said that they would work entirely at home post-COVID is expected to be dramatically lower. I think a hybrid will be adopted by some. But offices, the reason people worked in offices, even though Zoom has been around for 7 years, is that it works to work in offices in so many dimensions. One of the ways we can look into the future is look at New Zealand, because New Zealand took a tougher approach in terms of lockdowns to get rid of COVID almost entirely. And the result is, when we look at New Zealand today, we're looking at what Canada might look at, like if everything goes well by 2022. That is, New Zealand is a society that can pretty much behave as if COVID isn't there. And so what's happened? Well, Google does a pretty good job spying on people and where they're going. And they measure how much people are going to places of work or shopping or use of transit. And you can see by these bars that New Zealand has had almost a complete recovery on those dimensions. Workplaces, not quite so much, but remember that unemployment is still up a bit because their travel industry has hurt. But the only exception here, transit use, that's the only exception in New Zealand where actually you still have to wear a mask. So maybe that is spooking people a bit to stay away from public transit. But for the most part, people in New Zealand, Australia, and so on are working back at their offices. And maybe that's a clue to what our future holds. I think that's going to be less dramatic than some of the headlines that you see today. Housing has also been affected by COVID. We've seen a little bit of a rush to the suburbs away from the city, or at least a narrowing in the price differential in Toronto. You'll notice that didn't happen in Vancouver. It's been going the other way recently. I think, again, post-COVID, we're going to find that people realize that cities are fun places to live in when the bars and restaurants and entertainment venues are open. So I actually think that city properties will outperform suburban properties again in Toronto. We've had in the condo market a bit of a gap open up. New and shiny real condos have outperformed resale condos. We seem to be starting to make up for that early this year with a bit of a rally in the resale market. One of the things that I think, though, is interesting about the condo market is that part of it in cities like Toronto has been all about creating rental space. And what's interesting is that the investors who are buying condos today or recently and renting them out, many of them are actually in a cash flow negative position. They're renting it for less than they're paying in condo fees and mortgage payments and so on. And obviously they expect a capital gain or rising rents to make up for that. We'll see if that's right. But bottom line is, we are, I think, relying on not the best approach to creating rental properties. And I always tell people that when you hear someone say, oh, this politician, he's pro-developer, he's in the pockets of the developers, the accusation is sometimes that that's somehow, you often hear that from a left-winger. And I always tell people, no, you've got it all wrong. The only solution for high house prices is supply. If we're going to have 400,000 people come to Canada year after year when COVID is over, we're going to need more construction. We're going to need more density. And I think we're going to need more purpose-built rental of the type that is suitable for a family to live in. And that's going to require some changes in development incentives and zoning and so on. But all the tweaking you want to do on who can borrow and how much and so on isn't going to solve our high house price issue unless we solve the issue of getting more supply to match the population growth that Canada is trying to achieve in the coming decade. So that was the gist of my message, and I'll be happy to now take some of your questions.
Thank you, Avery. A great presentation on our economic outlook. I am hopeful that it's not an entirely new world, but a modified new world. We have one question here, and if anybody else would like to submit in the chat or in the Q&A forum, I can flip between both. One of the questions that we have, Dr. Shenfeld, is how is inflation rate calculated? We experienced a lot more than 2% increase in groceries, household products, etc. But it seems inflation rate hovers around 2%.
So people often ask that and say, my cost of living isn't up by 2%, it's up by more than that. And for any individual Canadian, that could be true. But it's important to understand some of the things that are the way it's measured versus what you may think of. So for one, is we often forget about the things that are falling in price. So the cell phone that you buy today, the features on it, even if it's the $1,000 cell phone, that might have been a $2,000 cell phone if you could have bought it 5 years ago. The car that you buy today, which has anti-lock braking and automatic braking for the car in front and so on, those were features that you might have been able to get on a Mercedes 5 years ago that you can now get on your Volkswagen. And they're bundled into the base price. And in effect, that's like a price cut. So there are items in the CPI, mostly technology, but even things like clothing, actually, where the prices have tend to actually fall year to year. The other thing that people don't realize is we don't measure the price of buying a house every year, because this is designed to capture what a typical person needs in their wage to keep up with their cost of living. Most people are living in the same house they bought 5 years ago, 10 years ago. And so what's actually happened to their cost of housing in the past year? It fell because they got a 5-year mortgage come due and they refinanced it at a lower rate. So their monthly payments are actually down. So these are some of the quirks in the way we measure inflation. And it's a reason why you tend to think that it's higher than it is. The other thing is nobody notices when they're paying less for something. You only notice when you're paying more.
Always. Next question. In your opinion, when do you see the condo market rebounding in the downtown core? I believe we're talking about Toronto. Over the last year or so, market conditions have been weak and favoring buyers.
Yeah, so we're seeing in the last month or so, maybe a couple months, actually a little bit of momentum there. And part of it may simply be that single family house prices got so expensive that now, the alternative is looking like a necessity. One of the problems is that rents are down. So in particularly in the Toronto core, a lot of those condos are bought by people who intend to rent them. And where did the renters go? Well, some of them are students who went home to mom and dad. Some of those are the waiters and hotel workers and people who were the very people who lost their jobs. People wondered, why was the single family market so strong? Because people who buy single family homes, they didn't lose their jobs. The job losses were airline workers and hotel workers and people who work in restaurants and bars and at the hockey arena. They tended to be renters. So we have a weak rental market. So really, I would expect at least that rents will recover in the downtown core when really COVID goes away, because these people will come back into the downtown as renters again. Condo prices, they are actually doing a little bit of catching up now. But I think a lot depends on, so I do think the gap a little bit will narrow a bit. The question mark I have in my mind are these investors, because how long will they still have an interest while we are in this period of negative cash flow? So I'm not hugely bullish on condo prices, but I do think they are coming back. I do think the vacancy rate will come down again when COVID is over.
Okay. And then moving to, with retail and office expecting to rebound in the future, do you think that the industrial real estate sector is a bubble for some of the cities right now?
No, I think that's real world. So first of all, warehouse space, as you know, has been sopped up big time by all this online retail activity. You need the warehouses, the distribution center. Sometimes you need to build a brand new one, mind you, because these are massive in some cases. I don't know if you've seen an aerial view of the Amazon, what do they call it? Fulfillment center, but that is one massive warehouse. So warehouse space has been in demand for very good reasons. And I don't think, as I said, that e-commerce will retain all of its market share, but it's certainly going to be bigger in 2024 than it was in 2015. So we've needed some of that space for that. I don't view that as a bubble.
Okay, thank you. Moving on to the next question. Many economists fret about Canada's productivity level. Do you think it has improved or worsened under COVID? Prediction for post-COVID?
So it's very hard. Productivity is ill measured during COVID, actually, because one of the problems is when you're running some industries at 10% of normal activity and some at 100, and you measure average productivity, you're getting a different mix of companies than the norm. And it's hard. We don't get the kind of data that would let us control for that. So it would look actually really high, because what's happened is we've lost all the low productivity jobs. Output per hour for a waiter is lower than output per hour for a steel worker. We didn't lose the steel worker jobs. We lost the waiter jobs. So it would be tough to tell during COVID, to be frank, what's happened there. I think the issue for Canada is really that this has been studied to death. And what we end up finding is that most of this relates to just the share of smaller businesses in our economy versus the US. I know the small business lobby may be on listening or whatever, but average productivity is lower in smaller businesses than large businesses. Our large businesses are just as productive as the US. So a Ford plant in Ontario produces just as many cars per hour as a Ford plant in Michigan. Otherwise, since they're both owned by Ford, why would that not be the case, right? It's just that we have more regional businesses, more local businesses, and really the only way we can improve that is by reorienting more of our companies towards trade, towards a larger US market, in other words, raising their ambitions for scale. We hope that free trade agreements would do that, and it may have done some, but I think we need more of it.
Yes. Okay. Next question. Thoughts on Feds taxing capital gains on principal residence?
I don't think that's going to happen for two reasons. So number one is the Liberal Party happens to represent, I think, all the seats in the Toronto area. So not exactly a vote winner for your party in one of the areas that actually you happen to hold a lot of your seats. So that's one political reason why. But the other reason is that it really, so you could think of this two ways. One would be a retroactive tax. Oh, surprise, the house you've owned for the last 25 years, you now have to pay capital gains tax. The problem with that is there's a fairness element there that can't be ignored. You were not allowed to deduct the interest on that investment the way you would have if you'd borrowed to buy, say, shares in the TSX. So are you going to allow retroactive interest deductibility? Like, there's no real way to do that. So I think it's very unlikely that you would do this retroactively. Now, you could say, well, let's start it going forward. Let's create a notional value for all houses now. And anything you earn from here forth, you pay a capital gains on. If I was finance minister and someone recommended that to me as a policy, I'd say thanks, but no thanks, because that's going to help the finance minister 10 years from now. It's going to raise almost no money now, especially if we start mortgage interest deductibility as a part of that, because then actually it's going to cost me money for the first several years until we're 10 years down the road and people are selling houses that have gone up. So I'm not interested in politically helping the finance minister a decade from now. Now, the only catch here is that, there are people who think we need to make the rich pay more. And a lot of wealth is tied up in houses. So could I envisage a day where they say capital gains, there's a tax on capital gains if you've made more than $5 million on your house? Yeah, that's a possibility. But it's really a disguised wealth tax. It's not about taxing the typical person who owns a house. I don't see that happening.
Okay, well, good. I'm glad to hear it. We have 3 more questions and then we'll wrap. I know that we're getting close to the bottom of the hour here. One of the last 3 questions could you comment more on the development of rental versus ownership housing? Is your comment on developing more family-sized rental units related to the demographics of people moving to Canada, or to a shift to co-living arrangements for single people looking to share rent with roommates in expensive cities? You've touched on this previously, but please go ahead.
And when I said it, I was really thinking about families, but it would apply equally to those sorts of co-living things. I think the problem we have here is that Toronto, Vancouver, these are getting to be expensive cities. And the problem with that is they get expensive enough, it actually starts to cut into your growth prospects, because you need a place within a reasonable commuting distance of the place of employment in order for the economy to thrive. And when you get to the point where that's not feasible for a typical, family, it becomes a constraint on economic growth. And you start to get people saying, well, maybe I'm not going to locate my company in Toronto because I can't get the workers I need because they can't afford to live in Toronto. Those are all bad things for the local economy. So if you think about the great cities in the world, and so here I'm thinking London, I'm thinking New York, I think of Manhattan, think of Paris and so on. You don't see in the middle of Manhattan a lot of little houses with lawns and so on. You don't have everybody owning your own house in Paris. A lot of people are renters, they're permanent renters. But what they have is they have rental spaces that are big enough for a family with 2 kids, 3 kids to live in. And we don't have that. We have a lot of 1-bedroom apartments, maybe a few 2-bedroom apartments. They're not really a big supply of that. And part of it is chicken and egg. People have not gotten used to the idea that that's an acceptable plan for their life, which is to be a renter. But you know what? If we built more of them, as single family houses get so expensive, I think there would be a demand. But we probably also need to incent more construction of it. And because right now, what a developer says is, I'd rather build a condo, I sell all the units, Everything after that, I've cashed in, I go on to my next project. I don't have to worry about what rents are going to be, maintaining the building and so on. I can understand the attraction of that kind of project. But the city has cards, right? The city could say, build an apartment, we'll give you an extra 5 stories, right? In other words, we'll give you more density. There's lots of things cities can do in terms of zoning and so on to incent the kind of construction that I think we need. Even development charges and so on, all of that can be used to create more rental property. And I think we need it. We also need to, though, the other thing we need is we need to get out of the idea that every time rental rates go up with the economy that we impose rent control, because that creates a disincentive. And people think, again, that that's a good policy for low income people. The answer is, it is great for the low income people who are already renting one of those apartments that's now rent controlled. It's terrible for the 20-year-old who plans to get an apartment 5 years later, because it discourages supply. And in the end, many liberal leaning economists do not like rent control as the strategy. They'd rather subsidize someone's rental payment or, again, incent more rental construction as a way of holding down rents.
Well, thank you for that. And you know what, we're going to end here just because we have reached our time limit. So Dr. Avery Shenfeld, I'd like to thank you very much for taking the time to speak with us today and provide your thoughts on the economy moving forward. And I'd also like to thank our signature sponsor, Oxford Properties, and Alicia Valentine for her contribution today, Sharon Cardy for administering. And I'd also like to thank our programs committee for all their hard work organizing. Also, all the Canadian Crew chapters that have participated today and coming together to work together. Melissa Jean-Gilles and Janice Duncan as well, the programs committee organizers. So thank you to everyone that participated today and called in. We hope you enjoyed our event today and have a great rest of the week.
Thank you, guys. Take care.